Yeah, and the low print was actually at the open, Carl. We're about 250 points off of the low. Let's take a look at the sectors. Global big industrial names, your industrials, materials, were on the weak side. Energy also on the weak side. China, of course, MCHI is sort of the proxy for China. More defensive sectors like consumer staples and healthcare generally holding up a lot better. The market risks, we've gone over them this morning. You've heard it all throughout the morning. The seasonality entering, as you heard from Jim, rather weak period for the next couple of weeks. Debt ceiling drama, Delta variant wave, and of course, trying to figure out that Evergrande fallout and to what extent there is actual systemic risk. Remember, a lot of big investors are into investment grade and high yield overseas. High yield debt is a big thing for a lot of American investors, so that's why they're concerned about some spread and contagion that's associated with that there. In terms of what's going on, we're off of the lows. If you look at some of the things that are associated with the global markets and the cyclical markets, oil and gas has been weak, copper miners have been weak. Value has come off of its lows. That's often associated with the reopening trade. And now we see the JETS, which is the global airline ETF, has now gone positive. That was down quite a bit at the open. So we've already had a turnaround just 15 minutes into the open here. In terms of thematic tech, that's been weak, and that's why there's a sort of general degrossing here. It's about a 2% decline that we've been seeing overall. So you see things like Cathie Wood's ARK funds down about 2%, some of the clean energy funds, some of the solar stocks, lithium stocks as well, all down 2, 3, or 4%, as you can see here. In terms of where we are, I kept emphasizing this at the end of last week. We've already had a correction in a number of big sectors, global cyclicals like airlines, big material names like DuPont, big global industrials like Caterpillar and FedEx and PBG, also in the material space. They're already more than 20% off of their highs. They hit their highs back in May. This is also true of a lot of the sectors that were associated with the reopening. Retailers, for example, hit their highs way back in May, and a number of them like Nordstrom, Gap, Abercrombie, Kohl's, they're already well off of their old highs. So this is part of a rolling correction we've been seeing that's been going on for many months now in certain sectors. The big question, is there serious downside risk to earnings, and could they be revised downward? They have been being revised upward for the third and fourth quarter. So far, the evidence not really there. It's pretty flattish. It's stopped going up. They stopped raising earnings estimates for the third and fourth quarter. But again, not moving that much. I'll have more to say this in the next few days. This is when you want to watch these revisions at this point. But I don't see any big alarm bells right now. Finally, when you're not sure what to trade on, you trade the technicals. So everybody's watching the 200-day moving average. 4106 is the 200-day moving average. That's about 7% below where we are. That's that gray line that you see. That purple line is the 50-day moving average. We've already essentially sitting right on that, slightly below it. So that would be, if we hit that 4106, Carl, that would be about a 10% drop. 7% below where we are now. We're already down about 3% from the old highs. And there you go. That would be the correction level. So everybody's watching that 200-day moving average, 4106 for the technicals. Carl, back to you.
All right, Bob. Talk to you in a bit.